do on there at all for
Now,
the Bitcoin, etc.?
Bitmex, this is Bitmex you're looking at now. They just do Bitcoin, Cardano, Bitcoin Cash, EOS, Ethereum, Chainlink, Litecoin, Tron, Ripple, and Tezos.
Yep.
And each
so
one
the
of
training.
See, like some of these tabs, like Bitcoin, that's 1, 2, 3. So there's 3 different charts there. This is obviously Bitcoin's always against the US dollar, but that's a perpetual contract and 2 different futures contracts. Things like Ethereum, you've got the perpetual contracts, Ethereum against the US dollar, and the other ones, not that it tells you that there, but that's Ethereum against Bitcoin, so, and their futures contracts. So that's all the Bitmex does. Binance is just cryptocurrency as well, but they do a lot of different pairs as well. And that's why TradingView is good, because you can pull up any old chart you like. Oil, gold, crypto, Forex.
But the MBA training doesn't do any Forex.
MBA training is on trading, which is exactly the same. It doesn't matter what as far as market analysis goes, like technical analysis, that's what they teach. It doesn't matter whether it's crypto or Forex or oil or gold or anything. It's still exactly the same. But yes, MBA is focused on crypto trading.
Okay, thanks.
But it's exactly, as I said, it's exactly the same. And you'll see the boys doing various different things from time to time as well, but the training itself is focused on crypto. But anyway, what I was saying was that, like on the daily chart here, you can see this uptrend. So, you got a low, you got a higher low, higher low, higher low, and, high, 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 high. So we've got an uptrend. But when you drop down to an hour chart, and I'll just have to scroll back to where we were. Now I'm lost.
Oh, I've got a very...
Sorry, I'm just trying to find where it was on the daily. Okay, that's fine.
Hmm? No, it's all right. They can't see.
Anyway, so on the daily, we just had that big uptrend. But if you have a look here, you can see, it's going down, going up, going down, going up, going down, going up. But on the daily, oops. On the daily, it was pretty much just, just up, up and up. But when you drop down to the hourly, you can see all the little individual up and downs. And that can be just handy if you're trying to, if you have a look here and you get to here, you can see it's an uptrend. So you can see it's an uptrend here, but you want to wait until the market retraces so you can place your buy order here. I mean, you don't want to place your buy order here. You want to wait for this retracement and place your buy order here. But on the daily chart, because each one of the candles is a full day, you basically got to wait it. If you're watching the daily and it did that and bang bang to here, pretty much here, once it started running down, you confirm that it's an uptrend, which means you want to place a buy order, but you don't want to place a buy order here. You want to wait for that retracement and place your buy order here. And if the market came right down to here, you'd have to wait, that's one day, and then you've got this little green one and another one, and then you've got this engulfing candle here. Once you got that, let me zoom in a bit more. All right, so we got this higher high here and it started to come down. So it's confirmed that it's an uptrend. So we want to place a buy, but we don't want to place it here. We want to place it right down the bottom, obviously, to get a better position. And if we're watching on the daily and the market got down here, we got this red candle and we got two little green candles. And once we got that big green candle, so that's an engulfing candle, that would have been an indication that the market had just turned here and was going to run up again. So, but you would have had to wait 1, 2, 3, 4 days to see if the market was turning so that you could place your buy order there. Whereas if you jump down to an hourly time frame, you know, you could have, you know, even if it was 4 candles, that would have only been 4 hours. You would have needed to get a bit of confirmation that the market had turned, and then you could have placed your order. So you can do it all on daily, but I find if you jump down to the hourly, you can get you can find out quicker if the market's turning around when you're getting ready to place an order anyway. So that's what I use the smaller time frames for mostly.
Or like I did this week and jumped to 1 minute to just have a quick look, and had forgotten I'd switched it to a minute because I've been trying to get out of that habit. And then I nearly had heart failure when I saw it shoot back up to the top. And I thought, oh my God. And then I realised it was only on a minute, so I was okay. But yeah, it's
you just got to be careful on the,
you're right.
Just got to be careful on the smaller time frames. Like an hour is okay, I think, but if you go down smaller, sure, do it. I'm not saying don't do it, because I do a bit on 15 minutes
just
quite
for,
often. But you've got to realise that
15 just for for entry.
Yeah, let's say this was on 15 minutes, the market could come, you know, the market could turn around here and run up, but the daily trend is still down, you know, and even though it looks like it's running up, you place a buy here and, you know, a couple of hours later it's turned again to run down. Whereas if you're on the day, if you're basing it mostly off the daily, so my point is, if you want to place I like the long-term trades because it's a lot less work. You know, I'm lazy. So if you're looking on the daily and you can see that it's an uptrend, then the best thing to do is place a buy order. But you can see in between each little run up, then there's a retracement, a run up, a retracement, a run up, a retracement. If you're on an hourly, you'd see the trend is going down just during this little retracement here. So you'd place a sell order, and you can do that, but you're only going to come to here to take profit, and it might not even come this far. Whereas on the daily, we've got an uptrend. If we place a buy order here, we get, instead of just making a profit on this little bit, we can ride this trade all the way up here. And the beauty of that is you'd never, if you wanted to do it properly and you get full confirmation that it was an uptrend, you wait for the retracement, you place the buy order here. I don't even know how far that is. Between here where you'd place it and where the market peaks here is 148 days. So this trade here, you could have placed, and it would have been 148 days later that you would have taken all your profit. And there's no reason why you should have closed out earlier, except, like Diane said, it's good to get a bit of money in the bag, which I like to do as well. But to do it properly, you would have placed a trade here, and the market would have went up, would have went down, and when it went up to here, and probably a little bit before that, I would have moved my stop loss up to just below this higher low. And the reason I would have placed, so originally when I placed my start, I would have placed a trade there. I'll just change that to yellow because that's what I do.
Mind if I keep listening?
Yep.
This is really interesting.
And then, I would have placed my stop loss for this trade. I've placed a trade right here. I would have placed my stop loss a little bit below this previous low point. And I'll put my stop loss as red. the reason for that is because if you're in an up, like we're
Over
in an
here.
we're in an uptrend, that's why we've placed a buy order. If the market then went up and came back down, like, I mean, if we placed our trade here and straight away it didn't go up, it turned around and came down here, as soon as it went lower than this point here, the previous low point, it would have negated the uptrend. It would mean that there was no longer an uptrend. So as soon as that happens, and a little bit further, bang, you close that trade out and you take that little loss. I mean, that doesn't mean that the market couldn't then start a new uptrend, but as soon as it forms a new lower low, that means this uptrend is no longer happening. So that's why we place a stop loss there.
Cross it over there.
Now, what you would do as far as where to place a take profit goes is we're going to have to zoom in a bit to have a look. And like in this case, we'd have a look and we'd see that here we've got a level of resistance. Okay, so I would place a line there, you know, because the market, you know, it's sort of broken through properly there, but then it's bounced on it and it's bounced on it. So that's a level of resistance. And other than that, I would place another level of resistance up here at this previous high point about there. Now let me zoom back out to where we were. So we've placed our trade here. We've worked out where to place our stop loss. And hopefully we're going to ride this trade all the way up. But we've identified a couple of danger zones. Like, hopefully this trade just keeps going up forever once we place it so we can make our fortune. But when we looked to the left, we found this area here where the market was touching all the time. So that's it. As far as our uptrend goes, this line is a danger zone because the market has previously used that as resistance and a bit of support. So this is a danger zone. So once your trade that you place here gets up near this line, there is a danger that it's going to bounce off that resistance and come back down. So just before that danger zone, it would be good, you know, probably there somewhere, and we'll make that green for a take profit line. It'd be good to take some of your profit there. You know, maybe 25% or maybe 50% of your trade you would close out and bag that profit. And then, you know, you'd come right up to where that next danger zone is and maybe put a take profit there, and then maybe just try and, you know, hold the last little bit of your trade and just see how far you can go. But you really need to have to work out where the market's most likely to go. And from where we placed our trade, there isn't much resistance until we get to here. So you wouldn't really want to take any profit until you got to here. And then you would probably think about it here, and then just, you know, I'd probably, what I tend to do is I'd put a take profit there for 50% of it, and I would, as soon as I could, I'd move my, so we placed our trade here, it's gone up, it's retraced, and it's gone up again. As soon as it got above this high point here, I'd grab my stop loss and I'd move it up to just below this low point, which is now above my entry point. So if the market retraces and hits that, I'm going to make profit. So there's no risk at all here at any stage. And then the market keeps going up. It hits this take profit, closes some of my trade out. So that's awesome. And then once, you know, if it doesn't bounce and come down, if it does what it did and keeps going up higher, I'd move my stop loss up to the next low point, and so on and so forth. As it got up here, you know, I'd move my stop loss up to this low point. But then when it got next to this next line of resistance that we identified, the next danger zone, as far as danger to the uptrend goes, once I got close to this one, I would either close out some more profit here, or and this is what often do, I would move my stop loss up really close so that if it looked like turning, it'd close it out. But, you know, by that stage, I've made some great profit. So where I took the trade out, my first take profit was 4.6%. And generally, you know, mostly looking at 10 times leverage. So that's a 46% profit there. And then by the time we got up to this next one, you know, we're up to an 81% profit on that trade. So if it retraces and hits that one at 81% profit, you're not going to be upset, even though the market did go a lot higher. So on this particular example, the potential was to go from there, and the market did sort of peak right up there, which is, I can't read it, 13%. So potentially you could have made 130% profit on that trade at 10 times leverage. But in actual fact, you would close some out here, and maybe if you're greedy like me, you'd just save a little bit to see how far you could push your luck. I think one point that you need to remember is that the stop loss goes there. That's where it has to go. You can't put the stop loss anywhere else. That's almost a given. And the reason is that it's because it's below, like the trade entry is here. This is the previous low point. While ever the market stays above this low point, it could still be an uptrend. But as soon as it drops below that, it's no longer an uptrend, and you don't want to have a buy order in play. So as soon as it drops below that, bang, it closes you out, and you would take only a small loss because, you know, if you're working out your risk to reward and all of that, you would have placed the trade there. The stop loss is on that red line. And our first take profit is there. And that gives us a 2.7 risk to reward ratio. So for every dollar you risk, you're potentially making $2.70, which is really good. Anything over 2 is great, really. But up to our next danger zone, now our risk to reward's 5.1. So that's getting pretty huge. So no matter how you look at it, this was a good trade. I mean, it's easy to say that because we can see what's happened, but, you know, as soon as you place this trade, so you place this trade and you put your stop loss here, which is 1.6% loss. So at a 10 times leverage, if you'd put up $100, then you could have potentially lost 16%, which, you know, on this trade, that would mean that you're only ever risking $16 at any one stage. But if you made it all the way up here, I'll just need my calculator, all the way up there. Yeah, I don't need a calculator for that. So on this trade, you've risked $16 to try and make $85. So, you know, that's pretty good. And like on that webinar we did with Troy and Zane the other day, if your risk to reward ratio is 5-to-1, then that means you only need to win about 20% of your trades in order to be profitable. And really, I don't think you need to know very much at all to win 20% of your trade.
Les, that's on your Bitmex. We can't take part of a trade in profit on MT4 platform, can we?
Yeah, definitely.
Can you?
You can.
Yeah.
Yeah.
Oh,
I do it all the time.
Not if it's only a 0.01 trade though.
Right.
But if it's bigger than that, like, because you can only close out in lots of 0.01. So if you had a 0.10 trade, then at any stage you like, you can go in, modify that order, and close only a portion of it. And what would happen then is you could go and you could close 0.01 of it or 0.05 of it. So 0.05 of it would mean you'd close half the trade, you'd take that profit or that loss, depending on where it was. And then that trade that you had, that was 0.10, would change to 0.05 because you'd closed out half of it.
Oh, okay. It brings up the box and you notify the trade. Yep. You have to excuse me, both of you. I've been eating my tea. You've probably already gathered that.
I hope it's tasty.
It is. It's fish.
Oh, nice.
Not a fish.
I bet it's very tasty in your part of the world. Yeah.
What sort of fish?
No, nanagai. Pretty good.
Mm-hmm. Your nanagai, different we are nanagai, but they're both good eating.
Yeah. They're pink,
Means nothing to me.
They're pink. And
pink? Oh,
they're
like
about table 4, about pretty high on the list of good fish to eat.
Oh, wow. What does it taste like? Like our pink fish would be like a salmon or a trout?
No, nothing, nothing like a salmon or a trout. Okay, this one here.
Oh, okay.
This is Nola's nanagai.
Oh, okay.
The one on either side are the two different species of nanagai that we get over here. This one being the largemouth nanagai, which is the pick of the eating ones. They get a lot bigger.
These are different, Liz.
Yours are like that, aren't they?
No, ours are, they're called a red bitefish. Like your nanagai you get over there.
Called what, sorry?
Yeah, they're not like your nanagai you get there. They're different.
I know that. That's what I was trying to explain.
Yeah, this is it. Yeah.
Did you catch it yourself then? Yeah.
Yeah, we go fishing.
Oh, wow.
You have to come to Australia and come and visit us all.
And eat fish. Lovely. That sounds great. I can't believe that you get different ones in different parts though, like that. It's amazing. I suppose it's like a different country. Yeah.
Is this what your nanagai looks like?
Wow.
No, that's more our pinky. Ours is, oh my God, no, where's Steve?
Doesn't matter. This is ours anyway, I know that much.
Do you fish as well,
Pardon?
Nola? Do you
Yes,
fish?
I love fishing. No, it's not like that. That's
Oh, wow.
No, this is that's what our ones look like.
Oh, okay. Yeah, I love fishing, Di.
Wow.
I had my shoulder done
That's
because I
great.
tore all the muscles off the rotor cuff. And I've got full range back, but I'm just building up the strength, and so I'll be able to go fishing again.
That stops you catching all the big ones anyway.
I know I used to have to hand the reel to Steve for about 5 months because I couldn't reel them in.
Wow. Looks great. Enjoy. Do you ever stack trades, Les?
Pardon?
Do you ever stack trades once you're in profit, put another one on if you think it's long-term uptrend or long-term downtrend?
Yeah, sometimes.
Or do you just, I just wondered.
Quite often I do. But
Yeah.
how I would do that when I do is like on here, after this retracement, I'd place a buy order here, and then a buy order. So on every little retracement, you could add another buy order.
And you're leaving your stop loss, original stop loss down there, yeah? So those new trades have the original stop loss, or
like if you put a buy order here, and then you wait for this retracement, you put a buy order. I guess at that stage you could pretty much move the stop loss for both of them up to that low,
right?
And then once it did a new higher low, then you can move the stop loss for them all up to the previous. Yeah, as long as your stop loss is below the previous low point, then you're pretty safe.
Yeah.
Because if at any stage the market drops lower than the previous low, then that means it's not an
Yeah.
uptrend anymore. So you want to get out of that trade anyway.
Mm.
Yeah.
And that's when, if you're ever using a trailing stop loss, that's one way you can judge how far you want it to trail behind, because you want it to trail far enough behind that it's still below the previous low point. You know, so if you place a trade here, if the market made it up to here, and you know you had your stop loss too close, the market was here, you had your trailing stop loss or your stop loss this close, the market could and would quite often flick back down here, close your trade out, and then continue on the uptrend, because it's only once it drops below the previous low that it's really no longer an uptrend. So whether you're manually moving that stop loss or using a trailing stop loss, you just need to ensure that it stays below each previous low point as it moves up or down or whatever's going on.
So if you use a trailing stop loss, are you sort of like trailing it by a certain percentage? Is that how you do it?
On Bitmex and most crypto platforms, you would work out the dollar value. Let's say the market was here, but I needed the trailing stop loss to be this far behind all the time. I would work out how much that is in a dollar value. This isn't crypto, but you just work out, that might be a $5 difference in the crypto. If it was a Bitcoin pair, maybe I should just go into a Bitcoin pair.
But you would do a trailing stop loss on a currency pair as well?
Yeah. So on a currency pair, you just trail it by a certain number of points, say 10 points to a pip. So you're just telling it to trail behind by a certain amount.
Got you, okay.
But on the crypto platforms, you're actually telling it how many dollars or cents to trail behind.
All right, okay.
So same thing, but different.
Actually, that's really
Yeah.
good, you showing that, Les, because I think that's one of my problems. My stop loss is too close. I've often thought
It's hard,
that, but I
like,
can't quite
as
fix
soon
it.
as when you're watching the market and like we placed a trade here and it's gone, by the time the market makes it to here, we're in pretty good profit, and then we see the market do this and we get scared and either close it out, or if we have the trailing stop loss too close behind, it just goes bang and would have closed it out. And then you have to sit there and watch the market go all the way up here, and then you're wishing it had never happened. You're just looking at how much money you could have made. So yeah, definitely. Like you just got to remember that if we place a trade here and the market goes to here, just because it starts dropping, that doesn't mean it's not trending upwards still. Because the market, doesn't matter what time frame you're on, rarely do you see the market just go straight up. It's pretty much always up and down, up and down. So the uptrend is always going to go up. It's going to retrace a bit. It's going to go up. It's going to retrace a bit. It's going to go up. It's going to retrace. It's going to go up. So you just got to understand that when it turns, this is most likely just a retracement, and then it's going to continue up. Instead of, and I'm speaking from personal experience here, instead of getting scared, because you see yourself here and you're in $50 profit, and then you're in 40, 30. Oh, I better get out of here. So you close out, and then it goes 40, 50, 100, 200.
Yeah.
But yeah, so that's why
It's a bit like a bungee jump, isn't it?
Yeah, that's why it's good to understand, to be
That's
able
what I
to
always
do
think.
market analysis, because then you can, if you're looking on a larger time frame, you can see that we're in a long-term uptrend. So particularly if on a smaller time frame and it looks to be trending down a bit, don't panic, because that's just still part of the retracement on the larger time frame, and it's most likely going to still keep going up. And I mean, it doesn't always do that, but as long as you know what's most likely, then you don't get as scared when it retraces a little bit. actually, they have a tool for working this out too. You probably don't want to see this yet, but it's just that this is that big technical term you would have all heard, the Fibonacci retracement. And if you wanted to use that, you click on the bottom, on the low, and let's say the market had come to here and then retraced to here, so it looks like it's dropping again. So you just put it up here, say this top line's on this top one here, and then you can see how far it's retraced. It's retraced back to the 38 level, 38% level, and that's the most common level that it retraces back to before going up again. 23, anywhere between 23 and 61 though, but 31's the most common one. So there's a lot of difference. It could turn here, it could turn right down here, or it could keep going. But if you're using this, you can see that it goes up, and as it retraces, you can see that it's still, until it gets down to this 61, it could still just be a retracement, so you don't worry. So without that there, you see it retracing, and you get worried that your profit's disappearing, so you close out. But just using this tool, you can say, okay, well, it's still well within the parameters, you expect it to retrace to at least here. And it just sort of reduces your fear a bit. I mean, I don't think you really even need that tool once you understand it, but it just helps you realise that it's going to retrace. Doesn't matter what goes up, even if it's going to continue up, it's still going to have these little retracements along the way. So you just got to know that that's always going to happen. Be prepared for it. And, if you're doing really short-term trades, well, that's fine. You can put a buy order here and you can close it out here and take profit. You can, and this is a legitimate way of trading too. We could place this trade here, and when the market starts turning, close it out. And then try and pick the bottom here again to place another buy order. And then we could close it and then try and pick the bottom again. But the biggest risk, or the trickiest part of trading, is picking that bottom. Well, obviously, if you can pick the bottom every time, there's no way you could lose on trading. So, down here, if we placed a trade here, it's not right at the bottom, but you can't expect it to be right at the bottom too often. But, getting a trade in there, I would say that's as good as can be expected position to get into the market. So if you closed out here and then tried to pick the bottom again, you've got a risk. And the risk at trying to pick the bottom is that you miss it altogether. So I prefer to just try and stay in the trade long term, close some profit out when you can. So if it does retrace, you don't lose all that money that you've made. But like, how good would this trade be? I mean, if we had have actually done what it says here, we've placed a trade here, and just kept making profit for us for 165 days. That's how you should trade. That's stress-free. There's not much work involved in that. Just checking it once a day and maybe moving your stop loss up a bit further.
That's a half a year.
Yeah, exactly. But it's going into more and more profit all the way. And you can keep closing out little bits as you go along. If you want to see your balance go up, you could close out a bit here, you could close out a bit more, a little bit more. But as long as you don't have to be closing out profit, but as long as you're, coming in here and moving that stop loss up every time you form a new low, every time you form a new higher low, you just move this up a bit further, move it up a bit further, and eventually it's going to turn and hit it. But by that stage, it's 165 days later and you've tripled your money. So who cares? It's hard to do that, though, because I like to be a bit more active than that myself, but I'm trying to talk myself into doing more of those long-term ones. I mean, it's never going to happen quite that well, but imagine doing that, placing a trade here. Every few days you come in here and you move your stop loss up a bit. And, half a year later, or, 100, close enough to half a year, 5 months later, you eventually get out of that trade altogether. But in that time, you know, well, in that time there, you basically would have doubled your money. Well, what did we say from here to the top was 133%, and then by the time it retraced and hit it, it's probably only 100%. So, you know, who cares if it takes you 5 months to double your money? If you could do that all the time, you'd be laughing. And how's the workload though? Just every few days you move a stop loss. Check your chart. You wouldn't even have to check it every day, but you probably would. And then once a week you might move that stop loss up a bit, and then eventually the market structure changes and turns, and you would have hit your stop loss. But you know, by then you've doubled your money, and you've hardly done anything at all. And that's still just a trick though, is trying to pick the very best entry point.
Especially if you're in a pair that is going to pay you to keep holding it, that would be even better. Because that's the swap charges are positive. That would be great, wouldn't it?
True.
For 165 days.
True.
Actually, what determines whether the swap charges are positive or negative? I don't think I've ever seen them positive.
On the Euro USD, you'll see them positive quite a lot.
Yeah.
Okay.
Let me have a little look-see here.
It's to do with the volume of trading, isn't it?
I'm not an expert on it, but it's banking charges that the broker pass on to us. So depending on whether they're getting like it's the interest rate that the banks either charge or pay, and it's depending on what pairs they are and you know which pairs increased in value or not, whether the broker's actually getting charged an interest fee or getting paid an interest fee, and it basically just gets passed on to us. Something like that anyway.
Mm-hmm.
I think a couple of the Euro ones do that, Nola. I think Euro GBP and Euro USD. I only know not because I'm holding them positively, but because I'm holding on to bad trades. So that's about the one positive thing about those trades.
Yeah, it's good to see. I'm just having a look and see what I've got at the moment. So we can show Nola some positive swap fees. Be exciting for her.
Euro USD does.
Yeah.
I did last.
And Euro GBP.
I think it was a couple of weeks ago. I remembered to take my take profit lines up to cover my negative swap fees when I'd held over 1 week, because I remembered I'd written it down because you talked about it a couple of weeks prior. So that was good. I covered all my fees and did quite well in the end.
It's a bit of a risk though, because you might just miss out on hitting the take profits then, but
well, you've got to sit and watch it. I sort of thought I wouldn't have walked away and left it, I don't think.
No, I wouldn't either. My internet's a little slow, so just bear with me.
I found a handy little tool. It's on forextime.com, I think it is. And it helps you with, you can calculate your pip value calculator, but also your profit calculator. And I find that good for when I'm trying to make it a break-even trade. You know, if I'm trying to move my stop loss up, but maybe I've held it for 3 days, so I've got some swap charges. Because I find that really hard to work out, because it moves so quick when it's moving to try and see, you know, where should I move it to. But that allows you to put in the pair, whether or not it's a buy or a sell, your open position, and your close position. So if you're doing it like to think, I want to move it to cover my swap charges, you think, right, well, I need to make, $8 on
Move
this
it up another
trade, then it
$8.
helps you to really pinpoint.
Yeah.
Yeah.
Here you go, Nola. So I've just sorted my trades. I've just clicked on the swap so that it shows all the positive swap fees. And they're all Euro USD ones. So I got $8.71 profit on that one.
Mm.
But some of these I've held for a fair while. So you wouldn't want to rely on that to make a profit, but it's good to see.
How do you compare? And it's negative and you've held on to it for ages.
Pardon?
I said, how do you then work out like whether it's worth having a long-term trade if you're getting negative swap fees? A bit like what you said, Di, I suppose. You just...
Well, it's just like, I mean, you can, obviously, the sort of size trades we're using on Einstein most of the time are only pretty small, but you can hold, 0.05 trade for, a month or more, and it'd still only be probably a negative $10 or something.
Yeah, it's not huge, is it?
So
The only real ones to watch out for.
You need to make an extra $10 in the long run on that trade in order for it to be worthwhile. And when we're talking about using Einstein, if there's 4 trades in play, where it puts the stop loss, where it puts the take profit for those 4 trades, it might only be a $5 to $10 profit minus the swap fees. So if you've carried trades for several weeks, you might have $20 worth of swap fees, but you only make $10 on that take profit line. So you end up $10 behind because Einstein doesn't take into account swap fees. So, if you've...
Well, you could even end up in the negative
You definitely
with Einstein if you had...
You definitely, that's what I mean. You definitely would. If you've carried trade for several weeks and then you just let it hit the take profits it's put in, you would most likely end up in the negative. It wouldn't be very much, and it would get you out of all that drawdown, so it's still not the end of the world. But if you can see that the market's powering in one direction, really forcefully going towards your take profits, yeah, sure, why not just move them a bit further? Even if you don't have swap fees and the market's really powering up, you can still move them up a bit, take a bit more profit.
Yep.
You've got to be careful, of course, though. Or you could move some stop losses into play in case it flicks up and down again. But, why not get greedy now and again? See, the beauty with...
Do you ever trade indices, Les? Oh, sorry.
No, I haven't done yet, no.
Sorry, Les, you were saying something else, but no, I dabbled a bit with US 30.
I haven't done oil either or anything, but I'm a bit of the opinion these days.
No, oil I don't like too much.
I'm a bit of the opinion these days that it really doesn't matter what you trade. Really, they're all much the same. As far as whether you can make profit off them or not, it's just a matter of finding one that's in a good position to, have a good indication of what's going on so you can place a good trade. But, I mean, gee whiz, there's like 6,000
I did a bit on
coins. There's probably several hundred different Forex trading pairs. If you can't find a good trade amongst that, well then probably not really looking too well.
No, I tried a bit on US 30 last week. It was quite good, especially if you watch it with the dollar. So you watch what the dollar's doing, and then you can obviously the reverse happens for gold. So if the dollar goes up, then gold goes down. But the stock market ones were quite interesting. But I found the margin was high. That's a bit of a shocker. You have to watch that when you start, because it eats your margin up. Like it's a bit like playing Pac-Man. It sort of eats it really quickly, which catches people out, I think. But it's some good scalping to be done, I think, on that. I've just got to get a bit better at it and feel a bit more confident. But I was doing that on demo just to sort of see. But it was Yeah, there was some good activity on it.
What I was just saying before was that, like, when you're trading on Bitmex here, you've got the perpetual contract, and they charge you every 8 hours a little fee. But if you're trading the futures contracts, you only ever get charged one fee, and that's either when you close the trade or when the expiry date occurs, which is the 25th of December in this case. So there's no swap fees accumulating or anything like that. Whereas with the perpetual, you're getting that little fee every 8 hours, so that's a bit like a swap fee. But on the futures contracts, I could take a trade out now, and I wouldn't pay any fees until the 25th of December. On the 25th of December, your trade's going to get closed no matter how it is, because that's when the contract expires, and then you get charged a fee. Or if I closed it tomorrow, I'd get charged that fee as well. So they're really good trades for good pairs to use if you're going to do a long-term trade, because you can go for several months without getting charged a fee.
Les, can you just explain with crypto, because there's something, isn't there, where your trade can't then go beyond a certain, so like when you're trading for FX, you can potentially eat into loads of your own capital, can't you? But
Yep.
there was something you were showing us
That's
showed us the benefit of crypto.
It's not just crypto, it's just how some platforms work, crypto platforms.
Oh, okay.
It's just called isolated trading. So let's have a look here.
Because that feels so much more secure somehow. That's why this appeals to me. But I feel I want to learn a bit more before I start.
If you place a stop loss on your Forex trading, you can't lose any more than that either. Isolated trading is just another way. So how will I explain this? All right, so I'll place a trade so we can. On Bitmex here, what you're doing is you're purchasing contracts of Ethereum and against Bitcoin. Each contract's worth 0.0004 Bitcoin. You don't really need to know that, but I'm just going to purchase 10. And so if I do a buy order, I'm probably going to lose a couple of cents here explaining this to you, so I hope you appreciate it.
Thanks. I hope you win.
Anyway, what will we do? Buy or sell? We'll do sell.
Oh, gosh.
I'm just guessing. I didn't do any analysis. But so you can...
I was going to say, that's brave.
I'm only doing tiniest little contracts. I usually do 1,000, so I'm only doing 10.
Okay.
So you can buy at market value, but you do get charged a little fee. It's only little, but you get charged a fee for doing it at market. If you want to do a limit order, you can just go, put it nearly at market value, and then you avoid that fee. But for me, that's a bit of messing around at times, and you miss the trade sometimes. But so if I buy 10 contracts at market value, and I do a sell order, so let's put in the sell order. So we've got the order in there now. Let's zoom in a bit, see if we're making money. It's been too small. Normally here it tells you how much money you've got to put up, but because we bought such a small amount, it's not registering. Hang on, let's buy some more. Right, so this is another thing that's different with the crypto platforms. On Forex, if you put in a sell order there, and then down a bit further you put in another sell order, you'd have two lines on your chart, right? Whereas with this crypto, if the market moves to here and then I put in another order, it just puts the line at an average position. Right, so
okay.
It doesn't really matter too much, but anyway, I'm going to do another sell order. All right, that's better. Now we've got 100 contracts. Something silly's happening. Limit. Limit. Anyway, it doesn't matter. Down here you can see 0.004 Bitcoin. That's how much Bitcoin I've put up as collateral to purchase enough money to buy 100 contracts. So the most I can possibly, if I don't place any stop losses or do anything, and the market goes against me, that's how much I can lose, 0.004, which is about, 40, 45 US dollars. So that's the very worst. It wouldn't matter if I had $100,000 in this account. The most I can lose on this one is that, because I'm on 10 times leverage. Let's say I decide, and you can change the leverage at any time. If I decide to change the leverage up to 50 times, if you keep an eye on this figure here, at the moment, if I change the leverage, I'll still only have 100 contracts in play, but the amount of money that I've got at risk will change. At the moment, I've got 40. If I change my leverage to 50, now I've only got, instead of 40, I've got 8. So now I'm only risking $8. Why would
So you can change that during the trade?
You can change that during the trade, anytime you like. And so let's just look at this. So I've got 100 contracts. That's the price that I purchased it at, and I did a sell order. If I hover on that, down the bottom of that black box, it says your estimated liquidation price after execution would be 437.95. What that means is that 437.95, if the market went the wrong way, went up, because I did a sell order, so if the market went against me and went up, and it made it to where the cursor is, that's when my position would be liquidated and I would lose my 0.004 Bitcoin. I'd lose my 45 bucks altogether if it made it to there.
Even though you don't have a stop loss in place?
Even though I don't have a stop loss in place, because only the amount that you front for each trade is ever at risk. And that's what Diane was talking about. It makes for a very sort of safe way. I mean, you can always put a stop loss and be it safe, but particularly when you're new to trading, everyone makes mistakes. I've done some stupid things at times and lost money because of it. This is just a safety net for beginners, really. I mean, if you don't even know what a stop loss is, you still can't possibly blow your whole account. Anyway, so at 10 times leverage, if I were doing 100 contracts, 437.95. Okay, so if the market goes all the way up to here, I would blow my money. I'd blow my 45 bucks. Okay. If I did 50 times leverage, okay, and I have a look at my liquidation price, it's 405.9. So 405. If I do a 50 times leverage, my liquidation price is here. Because the leverage is more, obviously, like any leverage, you can potentially make more, but you can potentially lose more. The market doesn't have to go very far against me, and I would, lose all my money, although it's not as much money at risk. But that's why Yeah, if you don't have too much leverage, you've got a bit of room for error. So I've placed a sell order here. Okay, it doesn't matter how good you are. You're never ever going to put the trade in the perfect position at the very tip, at the very peak, or the very bottom of the market. You're never always going to pick the very bottom or the very top. So you'd place a trade. So I've placed a sell order here. So more often than not, the market's going to go against me for a while and then go with me and eventually go into profit and hit my take profit. It's not very often that you place a trade and instantly goes into profit and stays in profit until you take profit. That's just luck, really, because you can't always just pick the bottom. Generally, you've got to wait for it to turn to get confirmation, then you place a trade, etc., etc. So on 10 times leverage, the market can go against me a long way before I'd blow my money. So it could go all the way up here, turn around, come down here, and then I'd make profit. Whereas on 50 times leverage, I've got to be very accurate with my trade placement because the market can't go very far against me before I would lose my money. But what I tend to do is I mostly always start my trades at 10 times leverage. So that gives me heaps of room. But like in this case, in this particular instance, I've placed a sell order here. You know, I'd put a stop loss just there. I'd put a stop loss there anyway. So I would never hit my actual liquidation point. But, you know, so I've put a sell order. My liquidation point's way up here and my stop loss is even closer. So, you know, if I went to here, I'd be losing $40. So I guess here I'd be losing $25 or something, you know, so really not a lot of money at risk. But once this trade went into profit nicely and I was able to move my stop loss to below my entry point, so it's a risk-free trade, at that stage,
change your leverage, presumably.
I changed my leverage. There's two reasons you would change your leverage now. One is it'll look the return on equity look better. That's just a vain sort of thing. But if you have a look at up here, my available balance, like my actual balance is 0.08 Bitcoin, but my available balance is only 0.06 because I have some in play, some in trades.
Oh, okay. Yep.
But so let's say this was now a risk-free trade and I want to change my leverage up to 50. So my available is 693. Once I change my leverage to 50, my available is now 725. So it's freed up a bit of my capital that I could potentially put into another trade now. So if you were really trading hard and you had a lot of your capital in trades ready to go, but then you found another good entry, that would be a way of freeing up some capital so you could place another trade. But anyway, good news is, if I put it on 50, my trade's in 7.8% profit. That's only because I'm on 50. But still, we've made money, not lost it while we're gossiping.
So, Les, do you always change the leverage once you've gone into a risk-free trade? Presumably, it's a no-brainer.
No, not always.
No?
No. As I said,
wouldn't it always make you money?
No, it won't make you more money because you've still only got the same amount of contracts in play. Okay, so it doesn't matter what you change your leverage to, you're still only going to earn off these 100 contracts. What will change is how much money you've put up at risk. Okay, so this is a video I watched today actually. Just a bit of an explanation for people on how these this leverage trading works on crypto. So we call these perpetual contracts and futures contracts. And the reason it's called a contract is because it's like a bank loan. If you take out a bank loan, you've got to give them your details and you organise a certain amount of time to pay it off. You're going to get charged interest along the way. This is exactly the same. Like if you're going to take out a home loan, they're going to say, okay, you've got to pay $500, or $2,000 a month. You've got to pay that back to us over a 25-year period. and we're going to charge you, 20% interest a year. That's how the contract for your home loan is going to work. They would also probably, I'd say always, say, you want to buy a $400,000 house, you have to give us $40,000 up front. So you have to give us a 10% deposit as collateral, otherwise we won't be giving you the home loan anyway. So this works exactly the same. So on 10 times leverage, I've got a contract with Bitmex to purchase 100 contracts. Now, let's just for, it's not exactly right in this case, but let's just say 100 contracts with $100. All right. So I've purchased $100. Actually, I better make it right. So actually, it's going to be about $400 for these contracts. So I've purchased $400 worth of contracts by having a loan with Bitmex, but I've had to put up 10%. Because I'm on 10 times leverage, I've had to put up 10%, which is $40. And then they've given me the other $360 in order to purchase this $400 worth. Once the trade's closed, I'll have to pay back the $360 that they've loaned me. And then I get to keep my deposit plus any profit that was made from the trade. So it's exactly like a home loan or a contract. So that's how it works on 10 times leverage. So if I was going to do 50 times leverage, that would mean instead of putting up 10% deposit, I'd have to put up, not 50%, I'd have to put up 10 divided by 5. So I'd have to put up 2% deposit. Right, so you've got to put up a smaller amount. So if I click on 50, it's going to change. This is basically my deposit amount, which is at the moment 10%. So like it's a $400 loan. So that's 10%, $40. If I change it to 50, it should become 2%, which is 2% would have been 8, but close enough. So now I've only had to put up a smaller amount because of the bigger leverage, but I've still only purchased the same amount. The contract, the loan, is still only for the same amount. So once I close this trade, I still have to pay back $360, and then I get to keep my deposit, which is only a smaller amount now, plus any profit that was made as well. But the profit's only going to be the same anyway because it's the same value of contracts that I've purchased. Did any of that make sense?
Yeah, no, that was really helpful explanation. Thank you. Yeah, I get you.
All right, well, I must love and leave you both. So thanks, Les. That's been awesome tonight. Thanks, Di.
Yeah, really helpful. Thank you.
You're really good. So, and enjoy your few days where you are, Les.
Yeah, you too. You're stuck at home.
Okay. Yeah, I'll enjoy
You're on
the rest.
holiday, Les.
Yes.
So you like holidaying.
We've got school holidays here.
Night, Lola. Night, Nola. Oh, have you? It's school holidays. Oh, wow. That's nice. So you've gone away. Hence the fishing.
Yeah.
Is that why
we
you
went
were
away
fishing?
last week, and we went out sort of into the inland areas and did some freshwater fishing. And now we're just at the coast on the beach.
Oh, wow. Looked like your son was doing well with his fishing.
Yeah.
With a bit of help?
No, not really. He's 16 now, so he doesn't need a lot of help.
Oh, wow.
Although